Australia's banks are preparing to bail in retail bank deposits. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
How are you going?
Very good.
So, part 3.
Yes, we are here to talk about part 3 of our 3-part bail-in series, and this is perhaps, Martin, the most important part of what we've been discussing. So just to recap for the audience, we talked about deposit insurance in part 1. Part 2, we talked about the difference between bail-in and the deposit insurance scheme and how those two different elements interact. And now we're going to talk about the risk of bail-in. Here's where when we get called conspiracy theorists by pushing this, we're going to present today some very solid evidence. So in 2019, we had HSBC. They did some dramatic things with their changing their terms and conditions for their main retail deposit account. And we're going to actually talk about what they did and why that's significant. And then we're going to start having a broader conversation about the big 4 banks, because there was some significant changes in 3 of the big 4. And then there were also some second tier banks like Bank of Queensland and some of the credit unions of the world. Massive changes to terms and conditions last year. And so last year I wrote an article about this issue, a 2-part series I wrote from my own website. And part 1 we showed in our part 2 about the issue between the bail-in and deposit insurance, and now we're going to go into what's actually happened with these terms and conditions. So we have seen bail-in happen in 2012-13 in Cyprus, where deposits was confiscated. We've seen in terms of the G20, they have been pushing a global regime around bail-in because they said that after the global financial crisis, the requirement for governments to bail out the banks was too significant from a financial standpoint, so they need a new mechanism. So this is where the Financial Stability Board looked at, what are the options around bail-in, and obviously when the G20 meeting happened in Brisbane, all of the signatories of the G20 signed up to a global framework around bail-in, including us. So we have New Zealand, that is the most transparent of the regimes around the world, saying that you as the depositor you must assume responsibility for the risk of putting your money in the bank, and you have to determine that risk. And obviously, this sort of the bail-in policy is happening all over the world. It's only here where, because there was a stink when the legislation was passed in 2018, there's been a denial that retail deposit accounts can be touched. And obviously we've seen the head of APRA, Wayne Byers, testify to Parliament to say that there is no such power to bail in, and yet you and I have found a loophole that we have exposed last year, this year, in 2019, and so obviously and to repeat the point that we made in our last show, bail-in has happened already in this country. So anyone who's saying that this can never happen, this won't happen, if we get into a financial crisis, we have a history of doing this throughout this country, and as the great saying goes, those who don't learn the lessons of history tend to repeat it.
And it's worth saying, the IMF has quite recently said, "Oi, get on with it, mate. You need to actually tighten up your bail-in rules."
Exactly. And the other point to be made is there have been attempts in 2019, but also in 2018 to tighten some of these issues up in Parliament. The major parties, in particular, resist any attempt to amend the legislation. So the government has, in its own ability, to change the law to basically quash any suggestion that this is possible. But anytime this is issues raised, they just say you're a conspiracy theorist, nothing to see here, and there are plenty of things to see here. And the evidence we're going to show today shows why this is a really big issue.
They always say, read your terms and conditions. Well, read your terms and conditions. It's really, really important that you do.
Precisely. So before we get into the terms and conditions, I just wanted, for the benefit of the viewer, just to take back to the key legislation, the Financial Sector Legislation Amendment, Crisis Resolution Powers and Other Measures Act 2018. So just a couple of elements just to set this up properly. So so there's two elements to this. The first element is the definition of what could be bailed in, which is what they call a write-off and conversion. So let's put this up on the screen. So basically what they did was Section 31 of the bill basically changed the definitions in the Banking Act, and this is 11CAA, and they said that quote, a conversion or write-off provisions means the provisions of the prudential standards that relate to the conversion or write-off of additional Tier 1 and Tier 2 capital or any other instrument. Now, that any other instrument, that is very, very broad. Now, initially when we thought about that, well, what does that any other instrument mean? Well, there is a particular requirement around these any other instruments. And let's go to this second slide, which is where they give further definition around this. So they basically say, quote, this section applies, which is about conversion and write-off, in relation to an instrument that contains terms that are for the purposes of the conversion and write-off provisions, so on and so forth. So what this basically saying is that the instrument to be converted or written off, i.e. bail in, has to have terms in there that expressly say that they can be bailed in. That's what the law says, and that's obviously where the loophole is, because the contract for a deposit account is the terms and conditions, that you have as part of your that you have a part of your bank account. And so if a conversion or write-off clause is inserted in your terms and conditions, this, in our view, and we've had this backed up by an independent lawyer, and when we did this show last year, we said to other lawyers, if you dispute this legal opinion, come forward with your own legal opinion. But the legal opinion we received last year was that that by inserting a write-off or conversion provision in the terms and conditions for a retail deposit account, that is sufficient to comply with this law, and this then gives APRA the ability to order the bail-in of a retail deposit account.
Yep. Despite what APRA says.
Exactly. So whether APRA actually understands the law, whether APRA has looked at our sort of shows in the past, I don't understand, how APRA has thought about the law. But and obviously we've said this in a few previous shows before, where people in Parliament voted for this act, who are opposed to bail-in of redeposit accounts. They took APRA at its word, and they never considered the loophole that we identified. And now that they've thought about a loophole, they've come to the view that, no, there is a risk around bail-in of retail deposit accounts.
I think HSBC is a really good place to start, John, because they were the first ones who basically tweaked their terms and conditions last year.
Yes. Well, yes. So they were one of the first ones, Martin. But the more interesting element that I was very shocked by was how blatant their new terms and conditions are. So when the establishment wants to push forward an agenda, I mean, your classic definition is, or terminology is, they use misdirection. And so typically, when you come to legal documents, it's written in such a way that if you read between the tea leaves, you can see it, but it's not so obvious. Whereas HSBC, what they did last year was quite obvious. And this new clause 10.7 says, quote, both you and we, as in you, the customer, we, the bank, will not be liable to each other for any of the following losses or damages, whether you or we knew or could foresee any of these losses or damages. And then they have a long list of damages, a long list of events. Now, the two key events is C, loss of the use of money, and D, loss of anticipated savings. Now, this loss of use of money, Martin, this is effectively capital controls. So this is what happened in Greece in 2012, where they basically said, you can only take out 60 euros a day out of your bank account. And basically, where there was internet banking or the ATMs, things were shut down. If you look at Lebanon today, there's capital controls in the banking system, Argentina, etc. So the loss of use of your money is, the money is still there, but you can't get it. But Part D, which is this is the key clause on bail-in, loss of anticipated savings. So basically, HSBC is saying, if you lose your money, and if the bank knew you're going to lose your money before you lost your money, we're not liable to you as the customer, and you're not liable to us. So that is the new paradigm which HSBC is now indicating to its customers. So the key question that I have is, so I don't know if this is just Australia based or whether this is a more global, if this has been a global directive, but for anyone who says that this is conspiracy theory, I read this and say that they have just billed the cat, and they just basically said that if you lose your money, we're not responsible. Even if we knew before you lost your money, you basically have to just cop that loss, and you can't sue us for us. And I just find that extraordinary.
Yeah. So it really has changed the relationship between the customer and the bank with regard to deposits. And basically they just said it's not our problem.
Now, what I should say, now, again, I'm not a lawyer, and I should say, declare, I've never been a customer of HSBC. Now, I would read this clause as saying this still probably doesn't meet the legal threshold of what the legislation says around conversion or write-off. I think there has to be more explicit language to say, we will convert this deposit. But like we said, in an emergency situation, the banks can change their T's and C's on a dime without telling you. They can insert new language in there if they need to, and then APRA can then order effectively the bailing of the deposit. Now, what these terms and conditions for HSBC now says is, no matter how it happens, you can't sue us. So there's basically no legal recourse if you're a HSBC customer. So I think that's quite significant. Now, we're going to go through some of the other big four banks and how they have described their new terms and conditions, and they're not as obvious as HSBC. But if anyone's saying that bailing can never happen in the modern age, well, why would a bank ever say something like this? That if you lose your money, and we knew you were going to lose your money, you can't sue us. So I want to now move on to Commonwealth Bank. So this is from section 6.2. So they have a table in the Commonwealth Bank terms and conditions that describes of their T's and C's and how they can be changed. But underneath the table there's a particular footnote, and let's put the footnote on the screen. It says, quote, "We may give you a shorter notice period or no notice of an unfavourable change if we believe doing so is necessary for us to avoid or reduce a material increase in our credit risk or our loss." Now, this language was inserted around May of 2019 for household sort of individual customers. The business accounts were changed in July for CBA, but that says to me, so before this language wasn't in there, and now the saying is, if we are at risk of losing money, we can just change your terms and conditions whenever we want, or no notice, and basically, that's what you sign on to when you become a customer of in terms of the Commonwealth Bank. And the point to make on this, Martin, is this is a point too that it's important that we repeat. These terms and conditions is a commercial contract. So when you open up an account, you basically are signing on to agree to these terms. And these are, so for a lot of Australians, and even before you immigrated to Australia, when I went through primary school, because the Commonwealth Bank was still owned by the federal government, all primary school children were basically, they were given a free bank account as a kid, and they were given these little Dolomite accounts where you were encouraged to save money in the Commonwealth Bank. So one of the reasons why Commonwealth Bank has historically had large market share in terms of Australia is because a lot of school children across the country were given free accounts by the Commonwealth Bank, and a lot of people have just continued that relationship from childhood, and they've never switched. But now Commonwealth Bank is saying that if we are at risk of a credit risk or loss, we can just change in T's and C's. Now, when is a credit risk or loss going to occur? In a financial crisis.
Yes. It gives them plenty of wriggle room, doesn't it?
Precisely. So the next bank to go on to is in terms of Westpac. So Westpac, as part of Part 4 General Information, Section 3 changes to terms and conditions. So this is the quote. We can also give you a shorter notice period or no notice if we believe that it is necessary to avoid or to reduce a material increase in our credit risk or loss. Same language as the Commonwealth Bank. And again, it is the same sort of risk that's basically on the table. And then we go on to ANZ. So ANZ says, quote, "We may make any other change to the terms and conditions of your account by giving you reasonable notice of the change. if we reasonably consider a change is unfavorable to you, we will give you prior notice of at least 30 days. We may give you a short notice period, which may include notice on the day the change takes effect. If we can reasonably consider the change has a neutral effect on your obligations, the change reduces your obligations, providing you a shorter notice period is necessary for us to avoid or reduce the material increase in our credit risk or loss, comply with any legal or regulatory requirements. So basically they're saying, if there's anything unfavorable to you as the customer, we're going to tell you 30 days in advance, unless if we are at financial risk, or unless if, in the case of ANZ, if there's a legal or regulatory requirement. So it could well be that in the case of ANZ, if APRA says we need to bail in, we need you to change your T's and C's, the ANZ will say, we've been ordered by the government, we've done it in compliance with the legal requirement, whatever the case may be, and therefore you have signed on to these T's and C's in the sense that we can just change it, your terms and conditions, because the government told us to. But then obviously this issue of, because this language is being repeated in most of these new terms and conditions, if there is a credit risk or loss. Now, when you have the biggest debt bubble in the history of the world, when you have significant levels of systemic risk, and there is a crisis happening in the repo market, and you've put a couple of posts on Walk the World, and I've written about this. I did a lot of research over the Christmas break. I've written a couple of articles on my website. It's a discussion we're going to have very soon. So when you look at the totality of the global banking system and the level of systemic risk right across the world, 3 of the big 4 banks are now saying that if we are at risk of credit loss, we're just going to change your T's and C's, and we don't have to tell you. And this is obviously significant, because this is the backdoor way of how, if there is to be bail-in, and again, like we said in part 2, bail-in is not an automatic occurrence, not an automatic outcome, but it is one of many potential outcomes that could be that could occur if one or many banks are at on the risk of being insolvent or in terms of facing bankruptcy. Okay, Martin. So let's move on to NAB. A quote: "In addition to the other changes NAB may make to the terms and conditions in this booklet, which are detailed in this booklet, NAB may change any other terms and conditions, including by imposing new fees or charges, changing the amount, type or method of calculation of fees and charges payable. NAB will make any changes in accordance with the applicable legislation and industry codes." Now, so NAB's, I would say, of the big 4, doesn't have this precise language to say we will change with little or no notice if there's a risk of credit risk or loss. So perhaps maybe NAB's a little bit more safer compared to the others because the language isn't as explicit. But at least for 3 of the big 4 banks, HSBC is the most obvious case. Now, in terms of second tier, Bank of Queensland has this language as the big 3 banks, and even some of the credit union building societies have very explicit language about the ability to change terms and conditions. So the key point to make is a lot of these changes happened in 2019. They give the banks enormous, and banks, credit unions, building societies, enormous flexibility to change the contract between them and their customers with no notice, and this is the key avenue in which, if there is to be bail-in or recapitalisation, this is the key mechanism in which it can occur. And one of the key pieces of advice that people, when they contacted me privately throughout 2019 and they asked me about bail-in, I always would ask, have you read your terms and conditions? And I would find probably 95% of the people contacted me, and I spoke to a lot of people last year. 95% of the people I spoke to, they said, I haven't read my terms and conditions. And I said, this is whether you acknowledge it or not, that you have a commercial contract with the bank. If you have a significant sums of money, and sometimes this was 5 figures, 6 figures that was in a particular bank account, you need to be fully aware of the commercial relationship between you and the bank, what you've signed up to, what risk your money, what risk you've assigned yourself to, and you have to understand that in a crisis, because we can read these terms and conditions when things are financially stable, but what people need to be able to do is imagine a world where the financial system is unstable, and how do these terms and conditions play in that unstable environment? Because that's when this risk of bail-in is really going to occur, not now, but when the crisis happens. And what can the government and the banks do in that situation? And it's very much like the issue on in terms of the $10,000 cash ban. The issue of the cash ban is not really, if they passed it today in terms of Parliament, the issue with the cash ban is not losing freedom today. It's losing freedom in several months' time when the policy environment changes. But this is the key concern I've had with all of these pieces of legislation, is they're putting the infrastructure in place prior to the next crisis. So when the next crisis comes, they're able to do a lot of ugly things which we don't want them to do, and they're doing it in a relatively stable environment. So the masses are asleep, and people are not paying attention to what's really going on.
So I think, John, your advice would be read those terms and conditions and really read them so you actually understand the implications, and then plan accordingly.
Yeah. So we've gone through the big four banks, which is 80% of the market roughly. We've gone through HSBC, which is the most explicit, in terms of their T's and C's. No matter which account you're a part of, you should go and look at you should look at the T's and C's. One point to make is that because one person contacted me last year and said, if I'm in a building society, am I immune from bail-in risk? The key point is that credit union, building society, bank, if they're an authorised deposit taking institution, if they're an ADI, they basically fall under the APRA banner. And the bail-in risk, it's applicable when you have that particular license. There are some non-banks in the market providing mortgages and stuff, but in terms of taking deposits and stuff, basically everything, all the key institutions that they're on the table, and people need to assess that risk by reading the T's and C's, and then having to think about, how much. Because the ultimate question, Martin, is because you are in effect have given a loan to the bank, and this is something you and I have said consistently, that by you putting your money in the bank, the bank is not a custodian of your money. You have given the loan to a bank. So if you don't want to give the loan to a bank, if you don't want to be subject to the risks that are in your commercial contract, there are some options in front of you. But before you make any conclusive financial decisions, you have to understand the risks that's associated with your current arrangement, and 95 to 99% of Australians haven't thought through their current position, and that's the purpose of our 3-part series, but also to talk about these terms and conditions, is to give people a more clearer picture as to what is the real state of affairs in this country. And
it's worth saying, John, isn't it, in closing, there are other options, but all of those options have other types of risks, because there is no risk-free alternative out there in terms of holding on to your cash.
Precisely, yes. So everything has risk.
Yep.
What I would say is that some options have a higher degree of risk than in terms of others. But when the government says that there is no risk around banks, around bail-in, around negative interest rates, and cash and all of this sort of stuff, there are significant risks, and part of what we've been trying to achieve for a year and a half, or nearly 2 years, is to unveil draw back the curtain and actually show people that the Wizard of Oz is really a little fat little man, on a big megaphone.
Interesting thought. Could that be the RBA chair? John, thank you for your time today.
Thank you.
Martin North, John Adams, interested people. We'll see you next time.